Hello and welcome everyone. Today we will discussing learning outcome 2, financial and finance and accounting. Be able to prepare financial statement for different types of business. My name is Yasir Gulfraz. I'm your tutor for finance and accounting. In our previous session, we discussed different branches of accounting. Also, we discussed profit and loss account, trading account, and then we discussed about balance sheet or financial statement. Today we will discussing how to prepare financial statement for different type of businesses, financial statement or important document that provide a snapshot of company snapshot of a company's financial position and performance. They help business owners, investors, and other stakeholders understand how the company is doing financially. So anybody can see my screen or anyone is there? Hello? Anybody there? Okay, if you have any question, please ask me during lecture or press the button if you can't see my screen or if any issue during the session, please let me know. So in our learning outcome 2, we will discuss financial statement, balance sheet, income statement, cash flow statement, statement of shareholder equity, profit and loss statement or P&L statement, techniques, accrual and prepayments, interest and interest adjustments, depreciation, debts, allowances. So there are 3 main financial statements. What are the financial statement in accounting? So there are main 3 statements, financial statements that we will focus on: the income statement, the balance sheet, and the cash flow statement. Financial statements are vital tools of evaluating a company's financial health. The income statement shows revenue and expenses over a specific period, which is also known as profit and loss account or statement. The balance sheet provides a snapshot of company financial position, and the cash flow statement highlights the inflow and outflow of cash. While the overall process of preparing financial statements remain the same, the specific items and accounts included may vary depending on the type of businesses. After the discussing different financial statements and the techniques used in preparing them, financial statements are important documents, and as I said, that provide a snapshot of company. So we will explore the financial statements that provide valuable information about company financial performance and positions. These statements play a key role in decision making for various stakeholders, including investors, creditors, and management. Let's begin, one by one. So with the first financial statement, which is income statement. Income statement, also known as the profit and loss account, as I told you before, presents profit and loss account presents a summary of a company's revenue, expenses, and resulting net income or loss for a specific period. It gives us a snapshot of the company's ability to generate profit by comparing its revenue and expenses. Moving on, the second financial statement, which is balance sheet. Balance sheet provides a company's financial position at a specific point in time, usually at the end of reporting period. It consists of 3 components: assets, liabilities, and shareholders' equity capital. The balance sheet follows a simple equation. There is an equation, assets is equal to liabilities plus shareholders equity. So finally, the last one is cash flow statement. Cash flow statement provides valuable insight into company cash inflows and outflows during a specific period. In categories, cash flows into three main categories: operating activities, investing activities, and financial activities. Cash flow statement helps us understand how a company generates and manages its cash. It allows us to evaluate the company's ability to meet its obligations, invest in growth opportunities, and distribute cash to shareholders. Any questions? Anybody is there? Or any question? Okay. So now here core principle is stuff that a business owns and stuff that a business owes. Differentiate between different financial statement. So financial statement, as we discussed, are financial statements are important documents that provide a comprehensive view of a company's financial activities and overall conditions. So there are four primary type of financial statements. First of all, the balance sheet, the income statement, cash flow statement, and the statement of changes in equity. So each of these statements serves a specific purpose and gives us valuable insight into a company's financial health and performance. So balance sheet, first of all, we discussed balance sheet or statement of financial positions. So balance sheet, which is old name. So now mostly new, that term is statement of financial position. So financial statement gives us a snapshot of a company's financial position at a specific point in time. It is divided into three main parts: assets, liabilities, and equity. Assets are anything of value that company owns, such as cash, inventory, property. Then second thing is liability. Liabilities are company's obligations or debts to others, like loan, accounts payable, etc. So the last one is equity, represent the residual interest in the assets of the company after deducting liabilities, which is often referred to us as stakeholder equity. So now moving on, the second financial statement, we have the income statement, also known as profit and loss account or profit and loss statement. This statement provides information about a company's revenue, costs, and expenses over a particular period. It starts with a revenues, which are income generated from the company's operations. From the revenues, we subtract the cost of goods sold to calculate the gross profit. Then we deduct operating expenses to arrive at the operating profit. After considering non-operating income and expenses, interest and taxes, we finally get the net profit or loss for the period. Income statement also help us understand how much the company has earned or lost during a specific period or time frame. Any questions so far? Okay, next one is cash flow statement. This statement focuses on company's cash inflow and outflow during a given period. It provides details on how cash is generated and used by the company. Cash flow statement is divided into three categories: operating activities, investing activities, and financing activities. Operating activities include such include cash flows from the company's core operations, such as sales and expenses, investing activities. Our cash flows are related to the buying or selling of assets like property or equipment. Financing activities include cash flows from activities like raising capital or paying dividends. The cash flow statement help us understand how well a company manages its cash revenues, or sorry, cash resources. So last one is statement of changes in equity. Statement shows how a company equity changes over time. It outlines the movement in shareholders' equity, including the issues or issuance or repurchase of shares, dividends paid, and changes in retained earnings. The statement of changes in equity helps us track how the ownership interests in the company have changed over a specific period. Financial statements are documents that provide a comprehensive view of a company financial performance and position. The balance sheet gives us a snapshot of the company's asset, liabilities, and equity. Then the income statement shows the company's revenue, cost, and expenses, helping us understand its profitability. And then cash flow statement reveals the company's cash inflows and outflows, highlighting its ability to manage cash resources. And the last one was statement of changes in equity, illustrate how the ownership interests in the company have evolved over time. By analyzing these financial statements, we can gain valuable insight into a company's financial health and make informed decisions. Here, a table shows a differentiate, between statements, financial statements, tools that provide a comprehensive view of a company's financial health, allowing us to make informed businesses and investment decisions. So first we have the balance sheet here, also known as, again, as I said, the financial or known as the statement of financial positions. This statement gives us a snapshot of a company financial position at a specific point in time. It includes three main components: assets. These are the things that a company owns, such as cash, inventory, equipment, or property. Then liabilities. These represent what a company owes, such as loans, account payable, or other debts. Then last one is equity. This is the net value of company and is calculated by subtracting liabilities from assets. Now, moving on, income statement. In the statement shows the profitability of a company during a specific period of time, typically, let's say a year or quarter. Key components include revenue, cost of goods sold, expenses, and net income. So revenue, it refers to the money earned from selling goods or services. Cost of goods sold, or COGS, these are the direct costs associated with producing the goods or services sold by the company. Then expenses, these are the costs incurred in running the business, such as salaries, rent, or marketing expenses. Then there is a net income. This is the final profit or loss achieved by the company, calculated by subtracting COGS, cost of goods sold, and expenses from revenues. Next one, we have the cash flow statements, which illustrate how a company generates and uses cash during a specific period. It consists of three main categories: cash from operating activities, then cash from investing activities, and then cash from financing activities. So cash from operating activities represents the cash generated from the core business operations, such as cash received from customers or paid to suppliers. Then cash from investing activities. This category show the cash used in or generated from investing activities like buying or selling assets such as property, equipment, or investment. Then cash for financing activities, the company cash transactions between the company and its owners or lenders, such as issuing stock or paying dividends. So last one, statement of changes in equity, statement of changes in equity. This statement shows the movement in owner's equity over a period of time, or capital over a period of time, and include the following components: issued capital, retained earning and dividends, or other comprehensive incomes. So issued capital, they represents the total value of the shares issued by the companies. Retained earnings, these are the cumulative net income of the companies that is retained within the business. Then dividends, this indicates the amount of earning distributed to shareholders. And then other comprehensive income, this includes income, expenses, gains and losses that are recognized in OCI or other comprehensive income rather than in profit or loss. So by examining these financial statements collectively, we gain a comprehensive understanding of a company's financial well-being, enabling us to make informed decisions regarding business operations and investments. So prepare financial statement for a sole trader. So here we will discuss the financial statement of a sole trader. Specifically, we will focus on three fundamental statements: balance sheet, income statement, and statement of owner's equity. So balance sheet is a snapshot of a business financial position at a specific point in time, usually at the end of an accounting period. It allows a simple equation, which is assets is equal to liability plus owner's equity. So income statement, let's take that income statement: net profit is equal to revenue minus expenses. So income statement present the trader's financial performance over a specific period, typically month, quarter, or year. It calculates the net profit by subtracting expenses from revenue. Here is the example of income statement, and this is example of balance sheet. Now, cash statement of a cash flow statements, an important financial statement that provides insight into the cash inflows and outflows of company during a specific period. This statement helps us understand how a company generate and utilize its cash resources. So let's begin, by analyzing the components of the cash flow. Cash flow from operating activities, the first, section, this here, or this first section of the, here cash flow statement is dedicated to the cash flow from operating activities. It's reflect the cash generated or consumed by companies' core operations. In our example, if you see that net profit is 6,500 pounds. However, we need to consider a non-cash item such as changes in working capital, which amount to 500 pounds. After taking these adjustments into account, the net cash flow operating activities or 7,000 pound. So next is cash flows from investing activities. This section covers the cash flow from investing activities which pertain to purchase or sale of long-term assets or investments. In our example, there was a cash outflows of £2,000 due to the purchase of equipment. Therefore, the net cash used in investing activities is also £2,000. Cash flow from financing activities, the third and section financing cash flow from financing activities. This section focuses on the cash flows from financing activities involving transactions related to the company's capital structure. In our example, there were owners drawing amount to £2,000, resulting in a net cash used in financing activities of £2,000. So here is, that according to the provided cash flow statement, the cash at the end of the year's amount is £10,000. So today, now we will learn how to prepare financial statement for a partnership. It is equipment quite similar to prepare financial accountment, that we just sold partnership, prepare for it is very similar to preparing a statement for a sole proprietorship. So, but with the partnership, we have more than one owners involved. The key difference in preparing financial statement for a partnership is that instead of a single owner's equity account, we have separate capital and drawing accounts for each partner. There can be two or more partners. So these accounts help us track each partner's investment and withdrawals or drawing. So as you can see here, partner A capital and partner B capital. So this statement shows the financial position of the partnership at a specific point in time. So the balance sheet showcase the partnership's assets here, then liabilities and the partnership capital here. So just bear in mind, it is important to note that the total assets always equal to the total liabilities. Okay. In income statement. In the income statement, we have two main sections, revenue and expenses. Revenue represents the money companies earn from its primary operations. In this case, the sale revenue is £20,000. This means the company made £20,000 from selling its products or services. The cost of goods sold, in this case, it's £7,000. The rent expenses, £1,200. Utility expenses, 600. Salary, £2,500. So by adding up all these expenses, we get the total expenses, which is in this case, £11,300. So to calculate the net profit, we subtract the total expenses here, total expenses from the revenue. So £20,000 minus £11,300. So net profit is £8,700. So statement of changes in equity. Here. The statement of changes in equity present the changes present the changes that occurred in each partner's capital account. So here we represent the profit allocated, that it's in a last year. We can see that here, if it's a net profit, the partner here, if we talk about profit between partners, so in this case, partner A will receive 4,350, and then partner B also received 4,350. So the total profit share for both partners amount to 8,700 pounds. So we come to the last section, which represent the partners drawing here. Partners drawing, which is here partner drawings, which is no. Here, the partner drawing is 2,000. Moving, the partner drawings 2,850 for partner BA and 2,050 of the same amount, like 2,850. So consequently, the total drawing for both partners sum up to the 5,700 pound. So lastly, here we arrive to the closing capital. This is the capital balance at the end of the period. Partner A's closing capital is 11,500, and partner B closing capital is also 11,500. As a result, the total closing capital for the partners is 23,000 pounds. So statement of changes, equity, present the changes that occurred in cash partners capital account. It starts with the opening capital, add the profit allocated to each partner, subtract the partner's drawing, and concludes with the closing capital. How to make, here we will talk about how to make adjustments to financial statement to ensure they comply with the occur basis of accounting. So any questions so far, or anybody can see my screen? Any issue? Okay, anybody is there? Okay, so this basis states that revenues should be recognized when earned and expenses should be recognized when incurred, regardless of when cash is received or paid. Accrued expenses are costs that have been incurred during the current accounting period but have not yet been paid for or recorded. For example, let's say companies employees work during the last week of December, but their salaries will be paid in January. So in this case, we need to make an adjustment in the December financial statement to recognize these expenses. Then same accrued revenues are revenues that have been earned during the current accounting period but have not been yet received or recorded. So imagine a company providing services in January to reflect the accurate picture of the company's performance. We need to adjust the December financial statement to recognize this revenue. These adjustments are essential to follow the accrual basis of accounting. This is many important point to remember, that these adjustments are essential to follow the accrual basis of accounting, which recognized revenues and expenses based on their economic activity rather than the timing of cash flows. So now it's a prepaid expenses. Unearned revenues and depreciation, these concepts help us accurately record the track expenses and revenue over the time. So prepaid expenses are expenses that have been paid in advance initially They are recorded as assets on the company's books. As time passes and the benefit of these expenses is consumed, we reduce the assets and recognize them as expenses. So imagine a scenario where a company pays rent for 6 months in advance. Each month, a portion of this prepayment becomes a rent expense. We allocate a portion of the prepaid rent to the respective month, ensuring our record reflect the accurate expense for that period. Revenues are payment received in advance for goods or services that will be provided in the future. Initially, these payments are recorded as liabilities since the company has an obligations to fulfill the goods or services. At the company delivers the goods or services, we reduce the liability and recognize its and revenue. To better understand this, let's consider a magazine that collects subscription revenue in advance. Each month, a portion of these funds becomes sale revenue as the company provide the magazine to the subscriber. Here, talking about depreciation. Depreciation refers to the reduction in value of a long-term tangible or fixed assets over time. This reduction can occur due to factors like usage, passage of time, wear and tear, and so on. So to accurately represent this depreciation in value, we make adjustments each accounting period to recognize the depreciation expense and reduce the assets value. If a company owns a piece of machinery, let's say if a company owns a piece of machinery, its value may decrease as it gets older and experiences wear and tear. So we allocate a portion of the assets value as depreciation expense, reflecting the decrease in its worth. So inventory, we will talk a bit about inventory adjustment and bad debts. These adjustments are necessary to ensure that a company financial statement accurately show its financial performance and position at the end of an accounting period. So inventory adjustments, sometimes inventories can get lost, stolen, or damaged. When this happens, we need to make an adjustment to remove the value of that inventory from our records and recognize it's an expense. So to do this, we typically increase an expense account by debiting it and decrease an assets account by credit. By doing so, we reflect the true value of the inventory on our financial statements. So bad debts, a customer may not be able to pay us the money they owe, and it becomes evident that we won't be able to collect that outstanding receivable. In such cases, we need to adjust our record to write off the bad debts as an expenses. So similar to inventory adjustment, we usually increase an expense account by debiting it and decrease an assets account by crediting it. So this adjustment allows us to accurately represent the amount of money we expect to receive from our customers. So that's it for today, guys. References here. So if you have any questions or anything you want to ask, please drop me an email at yasir@ukversity.co.uk. yasir@ukversity.uk.com. Yasir@ukversity.co.uk. So thank you very much for your time today, and see you at our next lectures, and bye for now. Have a good weekend.